Crypto owners, listen up. I'm a registered tax agent in Australia, and here's the truth. There are no special tax rules or rates for crypto. It's not just CGT. In this video, I will reveal how Australian cryptocurrency tax really works for all holders, break down a major Treasury tax amendment on whether crypto is treated as money, uncover the global tracking program the ATO is launching in just 94 days to spy on your crypto worldwide, and give you tips on how to legally reduce crypto taxes by at least 50%. Hi, if you're new here, I'm Veronica. Just a quick disclaimer. This video is for general educational purposes only, not personal advice. First, let's understand how the ATO track every crypto trade. So the ATO has been monitoring and collecting crypto data from all Australian exchanges, blockchain analysis tools, and global tax authorities to trace your KYC, every buy and sell, transaction history, wallet addresses, and account balance, going as far back as 2014. The ATO also uses data matching programs to compare your disposals reporting against information provided by brokers and banks to audit if it matches or has discrepancies. So if you've got any crypto gains you haven't reported, it's smart to report that now. Individuals have up to 2 years from the date of the issue of notice of assessment to amend or revise the returns. Now, from 1st of January 2027, the ATO and the OECD countries will implement the new crypto asset reporting framework, CARF. CARF will require foreign crypto exchanges to report every crypto trade, transaction, and personal identification details. This applies globally across all participating jurisdictions. And by 2027, this data will be shared automatically with global tax authorities like the IRS, HMRC, CRA, IRD, etc. to enforce transparency and tax compliance. Now, how does the ATO treat cryptocurrency? So the latest Treasury Laws Amendment 2022, Measures Number 4, Act 2023, being a federal law that has been passed, clarifies that digital currencies are not issued by an Australian or foreign government within the meaning of the Income Tax Assessment Act 1997. In simple words, digital assets are not treated Australian or foreign money under Division 775 Foreign Exchange Rules. That means crypto tokens, EFTs, and digital assets are treated as property, like shares, and not as money. Now, there's a lot of noise about Bitcoin or crypto being tax-free because of a magistrate's preliminary ruling involving a former AFP officer who stole 81-ish Bitcoins. Let's clear that up. Section 109 of our Constitution says, if state and federal laws conflict, federal laws prevails to the extent of the inconsistency. We all know that the state's magistrates and Supreme Courts issue rulings under state laws but upholds federal law supremacy. That's how the Australian court hierarchy works. Seriously, with the present administration trying to tax unrealized capital gains tax, spare bedroom tax, we don't know whether the next policy would be like a spare balcony tax. So you really think they're going to make crypto tax-free? In my personal opinion, that's a fantasy. Just let it go. Not under this regime, no. Let's break down how crypto tax really works in Australia for all type of owners. Again, there are no special tax rules or rates. How the ATO taxes your disposals depends on 3 factors: your crypto activity, your holding period, and whether your crypto disposal is a taxable event. This determines whether you'll be taxed under the existing ordinary income tax rules or get a special treatment under the capital gains tax system. So what is a taxable event in crypto? A taxable event is when you dispose, sell, swap, transfer, earn, or receive rewards with cryptocurrency. That means tax applies when you earn and or dispose of the tokens, not when you withdraw, cash out, or transfer the money to your bank account. Here's the most common activities that ATO considers or counts taxable events. 1. If you sold crypto for fiat, like Australian dollars or foreign money. 2. You swap one crypto for another, like trading Shiba for Dogecoin. A client once asked, why is converting crypto on Coinbase a taxable event? I told him, imagine you're selling an investment property in Melbourne to buy another in Sydney. The ATO wants their slice on the Melbourne sale because you've sold off that first asset. 3. Transfer crypto between entities, like from your name to a trust, company, or SMSF, and vice versa. Tax applies even if you're the trustee, beneficiary, member, or director. 4. You received crypto as income and dispose it later on, like from employment, freelancing, trading, mining, staking, airdropping, yield farming, and business or retail operations. 5. Using crypto for personal use to buy goods or services, and you acquired the crypto for more than 10K. 6. If you gift crypto to friends, wife or spouse, relatives, Wikipedia, or GoFundMe, non-registered ACNC or DGR entities, it's taxable at market value at the time of gifting, and these gifts are not tax deductible. 7. You can claim a tax deduction at market price if you're donating or gifting crypto to registered ACNC or DGR charities. But first, report the disposal at spot price and subtract the cost base to work out gains or losses. Don't worry, it cancels each other out. 8. If your crypto was lost, stolen, or unrecoverable, you can claim a capital loss to contra other gains if access is lost permanently, but evidence is needed. Now, any gains or profit made from these taxable events either attract the CGT regime or the ordinary income tax rules. So CGT laws applies if investors hold crypto for over 12 months before selling it. Only individuals, including individual beneficiaries of trust and individual partners in partnerships, qualify for the 50% CGT discount. Super funds get 1/3 or 33.33% discount, and companies don't get any discount at all. To calculate the net capital gain amount, investors must first subtract their cost base and any capital losses from the sale price, then divide it by 2 if you're an individual, or multiply by 2 divided by 3 if you're an SMSF or super fund. That's how capital gains tax works on crypto in Australia for investors. So CGT is a tax concept, not a standalone tax or tax rate. And you're a non-investor if you're trading, mining, staking, airdropping, yield farming, freelancing, or as business and employee accepting crypto as payments. Your earnings are initially taxed under the ordinary income tax regime or system, aka the marginal tax brackets, when earned or received without any discount. So to avoid double taxation, when you sell these crypto later on, your cost base is the spot price at the time you received these earnings. Your gains or profits is calculated as sale price minus the cost base and disposal fees. Here's a tip. Try holding it for over a year to access the 50% CGT discount regime. The same rules applies for businesses and retailers, provided that crypto isn't trading stock. And remember, you must report these taxable events in your tax return, even if you make a loss, because these losses carry over automatically and indefinitely to future years to reduce future gains or net earnings. That's how a capital loss carryover works for all entities. Now, how much tax you pay and what tax rates apply depends on your taxable income amount and your tax entity type or legal structure, like whether you're an individual person, a company, a trust, etc. And please remember that ATO doesn't tax each asset or income separately. Here's how the Australian tax system works. Your capital gains, business activity, and all other income must be recorded in your respective tax schedules or sections of the tax return. These are added to your assessable income. Then your assessable income is reduced by any allowable deductions. That result is is your taxable income amount. Individuals and sole traders are taxed at marginal tax rates, and the first $22,575 are tax-free due to low-income tax offset if you're a tax resident for the full financial year. Super funds pay a flat rate of 15%. Base rate companies are taxed at 25%, and companies are taxed at 30%. So non-human entities pay tax on every dollar of net profit. If you want to get more refund or pay less tax, watch this video on 18 deductions to lower your taxable income. Now, crypto is not a taxable event if 1. You're just buying and holding. 2. You're moving or transferring between your personal names wallets. 3. If someone gave you crypto as a gift, you don't pay tax at the time you receive it, but tax applies when you sell it later. 4. If you're using crypto for personal use, like to buy movie tickets or household items, it's exempt if you acquired those crypto under 10K. Provided that you hold for short term only. That's how Australia crypto tax works, guys. Watch this video to claim 8 CGT exemptions or concessions to pay 0 capital gains tax on property sale in Australia. If you find this video useful, please click like, subscribe, and hit the bell. And if you've got any questions, drop them in the comment and then I'll try my best to reply.